Good afternoon, everybody, and welcome to our next panel session, Stacking Your Odds, which revenue streams are most profitable. So I'm going to hand over without any further ado to your moderator, Corey, who is from Clean Horizon Consulting. So Corey, if you could come on the screen for me. And Corey is going to take you through the session today, and he's going to introduce our panelists. If you have any questions throughout the chat, please post them in throughout the session. Please post them into the chat, and Corey will be able to pick them out and will be giving your questions to the panelists at the end. Otherwise, thanks so much for joining the session, and see you later.
Thank you very much, George, and good morning, everyone. Good afternoon. It's a pleasure to moderate this session. I'll first start by introducing myself. So my name is Corey. I work with Clean Horizon. We are a consulting company dedicated to energy storage, and we have two activities. One is technical consulting. So we help our customers size and purchase energy storage projects. And the second one is that we are market analysts, which means that we help our customers understand the energy storage markets worldwide. And I'm not alone today. We've got a great panel laid out. We've got 45 minutes ahead of us. So I'll introduce you to the panelists, and maybe panelists can turn their camera and mic on as I call them. So we've got Mark Simon from Eelpower. We've got Catherine Newman from Limejump. We've got Andy Hadland from Arenko, Aaron Lally from Vest Energy, and Andrew Lycett from Sungrow. So probably the first thing we'll start with is an introduction. Maybe everyone can take a minute to introduce themselves, and then we'll tackle a couple of subjects on the revenues. We've got three big items laid out. The first one is dynamic containment, which is a frequency regulation revenue in the UK. The second one we'll tackle is other services, such as reserves, such as reactive power. And the third one is trading revenues for batteries. So let's start with the introduction. Maybe Andrew, you can start and take 1 minute to introduce yourself.
Yes, thanks, Corentin. My name is Andy Lycett, and I'm the country manager for the UK and Ireland at Sungrow Power. As many of you probably know, we're a company that's based out of China, headquartered out of the city of Hefei in eastern China. And we're famed, of course, for designing and manufacturing ESS systems and PV inverters, amongst many other things, of course. And then we ship those clearly.
Thank you very much, Andrew. Aaron, you want to go next?
Thanks, Corey. Hi, everyone. Aaron Lally, Vest Energy. Vest Energy are a clean tech trading house focused on grid-scale battery storage. We look at standalone storage. We're increasingly looking at storage co-located with renewables and load. And really what we're trying to do at Vest, alongside trade assets in short-term trading markets, so day-ahead, intraday, imbalance and balancer mechanism, we're also trying to push these assets into the longer-term trading markets. So our background and the background of our founders has been both short-term and long-term electricity market trading at some of the largest commodity traders globally.
Thanks. Andy?
Thanks, Corey. Hi, everyone. Andy Hadland here, Chief Product Officer at Arenko. We have in the past owned and operated big battery storage assets. But now we've got a software platform that enables you to get the most out of those assets. And we really see flexibility as software-defined assets. So focusing on the software part is what we're really interested in. We think that you can get additional value through automating. And we are also making our software available to other parties in the energy sector so that they could use our software to trade their assets as well. That's me.
Thanks. Kat?
Hi, I'm Kat Newman. I'm the CEO at Limejump. I think we're one of the older companies at the table today. So we've been trading and managing assets for the last 6 years, both optimizing and trading them in the wholesale market. So we don't just do batteries, we do field assets. We obviously do lots of PPAs as well. So we have a large renewable portfolio as well. We like the combination of the two, of both the technology side and the trading side. You know, we think the combination of the two will bring the best value for you from your assets in the longer run.
Thanks, Kat. Mark?
Good afternoon, everyone. I'm perhaps the odd one out in that we're really interested in the outcome of all this good work. Eelpower was founded about 4 or 5 years ago, and we are really about being the best way for capital to deploy itself and get access to the market for flexibility and electricity volatility as that market grows. And we've our focus on that, if you like, has been unchanged since we founded in 2016-17. We have concluded that the best way to do that is to own, operate, and optimize batteries, and do so in a very collaborative way. So I'm happy to say that I've worked with many of my fellow panelists, or we have rather, but basically aiming to work with the best routes to market. We're a long-time customer of Limejump, for example, but also looking at the best technology providers as we go forward to attempt to get the most ambitious outcomes from the battery platform that we own.
Thanks, Mark. Actually, this is going to be very interesting because we have three aggregators, so really route to markets. For storage, we have one storage manufacturers with Andrew, and we have also Mark with an investor point of view. So there's really all the energy storage supply chain here. Feel free to ask questions all along the webinar, the panel. I'll take them either as they come or at the end during the dedicated Q&A session. But let's start with now really the discussion, the first bit and discussion of regarding the revenues and the ancillary services, which have been driving the deployment of storage in the UK since the market started in 2016 with the first 200 megawatt procurement for frequency response. So now this has changed and is now called dynamic containment. It's a new kind of service. It's a very short-term procurement. There's, I think, approximately 500 megawatt of batteries pre-qualified for this. So let me first turn to probably Andy, because you're operating currently on this market. What's your take on the DC dynamic containment product, and why is it so challenging for batteries to be there? Because for everyone's background, there's the market size is larger than the amount of batteries pre-qualified today.
Yeah, absolutely. I think there was a discussion on this a little bit earlier where my colleague Roger Holly was presenting. So there's some good detail there. To build on that, they've talked about the hardware requirement, the data requirement. And one of the challenges that wasn't talked about so much is, yes, it's challenging, but it's overcomable to get the quick speed of response and to turn assets that might otherwise be slower into being able to provide this market. But the other piece is linking that in with the data availability, data visibility to the market, to National Grid. And we've recently done that, being the first provider to be providing real-time monitoring to National Grid for non-balancing mechanism units. And that's really blending the controls capability and that data capability together. And I think that's an emerging challenge that's going to come up pretty soon for those active in the market.
So this ability to take data and having the ability to merge the technical capability and the data communication.
Yeah, I think the one that people focus on is the technical challenge, and that is a challenge, but it's being overcome. But the data side, is the next one, I think.
Yes, because dynamic containment is 1 second response time, so it's not more than the EFR back in 2016, right?
It's quicker than that. So it's under half a second, and you have to sample 20 times a second. And that generates about 17 million data points a day per asset or per unit. It's a lot, but it's not a lot in software world. But if in line with the data task force or the energy data task force recommendations, having this data availability, this data openness is something that's really important to transparent and efficient markets. And that's why yes, it's challenging, but it's a really good idea, and you can see why we're focused on the software side as well as the physical control. But I'll let someone else come in.
Thanks. Mark, you've been operating batteries in the storage market for a while now. So this new ancillary services is just another one, another new event. But how
it is, if you like, just another chapter. But it is all the things that Andy and the team there said. I think it's a great. It represents great creativity, evidence of great creativity, both on behalf of the ESO and those that have stepped up to it. We really did see a blossoming of application opportunities, of which this is the biggest in the last 6 months, which must have something to do with what happened in the world. But it also does talk to the fact that batteries application sets will continue to grow and evolve, whatever you call them, whether it's EFR, the old static frequency response, which was the first batteries we did in 2015, God help us, and then the first firm frequency response, which we did with Limejump in December 16. And since then, some of the large contracts we've been lucky enough to win. I think DC is just the next chapter, and we shouldn't get too obsessed by it, because of course it's going to drive through sampling frequency and things like that. And that data is the lifeblood of this industry, because in the end, the thing we're trading is not electricity, but it's volatility. And an understanding of that platform and how these things represent a concentration of the risks and the opportunities in the electricity market, and thus become significant assets in the market, comes out of data-rich applications like DC. That's our contention, and I think it's certainly the contention of most of the people at the table. So I'll let them talk for a moment.
Aaron, do you think this is a new chapter, or is just the close to same chapter than other ancillary services, just another one?
I think it's very much a new chapter, primarily because the revenue is almost double what has historically been available in the FFR markets. I think just to kind of follow on from what Mark and Andy said, the data side is now key, and more specifically the 20 data points a second. And it seems like National Grid have set a blueprint in this service for future services, so dynamic moderation and dynamic regulation. So if you're unable to do it, and you're unable to sample at that level and provide the data National Grid wants, you're not going to be able to compete in any ancillary service market going forward, as the FFR markets or the traditional FFR markets get drafted out and replaced with this new service. So yeah, I think it's very much a new chapter, and I think it's really driven investor confidence, and they're not going to hang their hat completely on the fact that the asset will be operating in this service for the next 10 years, because obviously it won't. These markets will become saturated the same way the FFR markets did, but it's very much setting a new blueprint for the market moving forward.
Maybe Kat, on this, when do you think this market will saturate? So when do you think we'll start on seeing this price, which is still currently, I think, around £17 per megawatt per hour, start and decrease because the market gets saturated?
Well, it's really interesting. I think National Grid this morning stated the requirements for over the summer have just gone up to 1.1 gigawatts for the summer, and then for the winter they're going to 800. So I don't think we're going to see any drop in prices probably till back end of the year, November earliest. But I think we have to not get too focused. It's not all about DC. DC, it's a really important part of the stack, but it's about how we stack everything up together. That's how we're going to make the most money for investors in these assets, how we're going to, get the best value out of them. It's about, the ultimate question is, should we be able to vary products by ether block? Ideally, you want to go into DC for E for 1, you want, FFR for E for 2, then you want to be in a wholesale trading market across 3 and 4, then maybe you tried an E for 5. It's a mixture of all those different things. And that, from a technical perspective, forms a massive challenge. I know one of the questions people are asking are like, why aren't Limejump in DC yet? You have to remember we're only in partial DC right now. The 4 products coming in April. We're very much focused on, we made a commitment to Penso. At the time of signing, it was the biggest battery in Europe. It's a 100 megawatt battery that's coming online next month. And we'll be bringing that into DC then. We're really focused at Limejump on the longer term view about how technically we can stack all of these different products together, how we can solve those challenging problems. We want our customers to be able to clear you know, at the best price. If you don't clear the volume you want at the premium market at the time, whatever that may be, it's DC right now, but more things will come on. You want to put the remainder on the next one, and you want to be chopping and changing, and all that will have to be run automatically. So I think it's a really exciting time. There's a lot of different things coming on the board, but it's a bigger picture than DC just together. And, you know, that's what we're focusing on, the longer term view.
So what are you preparing next after DC?
Well, there's lots of different things we're doing right now, and I'm not going to tell everybody sat around here what I'm doing.
Okay, well, at least I know coupled to DC, Andy, you've already experienced coupling it with a balancing mechanism, right? Maybe you can touch on this.
Yeah, absolutely. Yeah, we've been pushing to unlock the flexibility of these assets for a while using software, and we were able to prove with our digital twin capability that we're able to do it from a long time ago. And then finally, on the first day it was able to be done, we did it on the first day. So we combined a balancing mechanism instruction with dynamic containment. That is really complex for baselining reasons. But not only that, we actually, a couple of days later, combined it with a wholesale trade at exactly the same instance in time. So that future is here now, it exists now. And just with stacking with dynamic containment and the balancing mechanism, we saw already a 3% increase in overall revenue. That's against £17. So if the price of £17 drops, that 3% becomes 5 to 10, and that becomes interesting. You know, we've had negative prices, and we haven't got a cost of service anymore. It's actually negative because we're getting negative prices to charge back up again. And one of the reasons, we're absolutely focused on this and more. They're fantastically interesting markets because one of them is a local control loop, super fast hardware integration. Another one is a payer's bid centrally dispatched by National Grid deciding what happens. And the other one is a wholesale market where it's clearing on the European Power Exchange. All these different things all combined together seamlessly as one piece. And I think it's fantastically exciting. It's adding liquidity to markets, more revenues for battery owners, and also more liquidity and more efficient markets for everyone else.
Yeah, and more challenges. Yeah, sorry.
Yeah, just to say, I think one thing to bring back in here at that point is great as all the automation stuff is, you also need to have that. Now, I think as Aaron would also agree on this front, is you need to have that gut side, that whole, for the wholesale trading piece. It's not just about automating everything up on the wholesale trading piece. You need to have your traders there 24/7, looking at the market, see what's going on, being able to react really quickly. I think in terms of the market, we actually have a trading desk that sits there at a desk 24/7, as well as having all the automated stuff too. So I think I totally agree with Andy. All the technical stuff is fantastic, but you need to have a combination of the two different things, managing all of that. And having that experience is paramount.
Just before we deep dive into the question of automation versus trading, maybe one question to Andrew. So we've discussed we need more data, we need more sampling. Have you seen how has the market evolved, and especially regarding the request from investors or from the technical perspective?
Yeah, it's a good question. What we're finding is, as the advent of stacking comes around, is the battery's being asked to do more. It's putting limitations on obviously the physics, and that has an impact on the warranty that we can offer, and the industry can offer. So there's particular pressure on the cell manufacturers. So we back all of our warranties off onto the cell manufacturers. But of course, as time moves on and customers expect increasing warranties as product becomes potentially more reliable, more stable. But of course, with stacking, it's a kind of potentially an unpredictable load profile because it's being used for frequency 1 minute, it's being used to do a capacity market the next, doing something else the next, and these different stresses and strains on a battery, and so that's what we're seeing. So we're seeing some, although not particularly too much in the last 12 months, but we can certainly see the way the market's going. In terms of having to be more creative in terms of the warranties that we're offering.
So how do you deal with this? Do you give a maximum? Do you give them a maximum degradation for a degradation for the maximum amount of cycling they ask?
Yeah, we analyse the profiles and assess them and either approve the warranties and of course some customers want increase warranties, or they want specific SLAs around the technology that we're offering, not just the batteries of course, but the PCS as well. And then we would draw up a bespoke SLA for that particular contract and that particular customer. We pride ourselves at Sungrow. We take each project as its own individual entity on its own merits, and I think that's the right thing to do, because different customers have different drivers, and the way that the O&M is done, the location of the project. All of these things have to be factored into an SLA, and also, in terms of what we can find the limitations of what manufacturers can provide. So we try and bring all this together and work with the customer, and we very much encourage the engagement of what are you trying to do here? What do you need out of your system to ensure that customers are kept happy?
I think
okay.
Corey,
yeah.
just to pull some of those thoughts together, I had three thoughts as they were going through. First and foremost, I think, and some of the questions that have come up in the background, for those of us who intend to own a large platform with these batteries and already are building those out, and our recent announcement with Susie Partners was out in the last month, we are looking to benefit from the creativity and the energy and the excitement that Andy and Kat and Aaron describe, because actually all of these routes to market are valuable to us, and the contention between them is valuable. So just as Aaron was quick to point out that DC's another thing, and then we can compare it against the arbitrage markets in their various forms, and then we've got ODFM and we've got reserve in the BM and all the other different manifestations and other applications, as well as all the other dynamic services shortly following down the track. We see this in terms of multiple partners to work with, which also has a mitigating effect on risk, but also it means that we can say, oh, this guy over here is doing something interesting, or this team has got something new that we hadn't got before. But so much creativity going on in the UK market, I think that's really valuable. As regards a question we've just had, how do we, how does DC, if you did DC, impact hardware performance? I mean, and how does that impact back on the assets that, let's face it, are the thing that we're buying from the manufacturers like Sungrow and our other manufacturers, is what we make it our business to understand the back-to-back around that. So whilst it's really good to have routes to market who really get batteries, and that's somewhere around this table, it's also vital for us to ensure that the getting of those batteries is tied up with contractual safety that ensure that we don't end up having something that's broken. The irony about DC is, of course, it uses batteries significantly less than where we've come from. And that actually provides an opportunity for us. We have batteries with longer lives, potentially. But you know what? In a year's time, we'll be talking about something else that makes a fantastic amount of money and uses batteries like hell. And so we'll have a different set of questions, and you'll have to invite us back. But I think it is a bit like that. Each part of this puzzle, whether it's facing off against the developers and their land, their sites, and where the best locations are, or the manufacturers, or indeed the routes to market, a sensible owner and somebody who's aligned with the capital that's going into owning these batteries needs to understand the relationships between each of these. This is not like solar; it's more complex.
Yeah, I think that's a very valid point, but practically, Aaron, for instance, have you been already limited with the batteries you are operating because of the back-to-back guarantees that the investor had signed? Because we can imagine that in the audience today, we have people looking to buy batteries. What would you recommend them? Is there a specific aspect they need to look into? Have you been prevented from participating into certain markets because of the guarantees that were signed?
So we're yet to bring a asset in on a short-term optimization contract. We focused on the longer-term markets, and we think that's where, at the moment, we can build our expertise and and really show the market our offering is slightly different. We do all the day ahead, intraday imbalance, balancing mechanism trading, and we have models set up and the ability to just batch into those markets. But the recent deals we've priced and signed have been more around the derivative space. So allowing, and it's kind of a common question. We've probably got a lot of investors in the audience today, hopefully, and the question regularly is, okay, well, we don't want to wait until day ahead or intraday to monetize our sites. We need some sort of guarantee or forward cash flow that provides us with an element of comfort that we're not going to be waiting until the same day or the day before to try and monetize the site. So what are we looking at? We're looking at the derivatives markets that thermal generation and other types of generation have used for decades. The UK power market established 1999, and a lot of centralized generation today has made very good money trading in these markets. So I think it's very akin to what Arenko have done and on the short-term markets. The framework in the longer-term markets doesn't suit distributed energy, particularly batteries. So what do we have to do? We have to change that. We have to change the type of products we offer in that space. So I think the same way, and that's the best way to describe it. And particularly Arenko have done a great job in the balancing mechanism and the reserve from storage trials. They're changing market frameworks, and that's what needs to happen to push towards net zero. We're trying to look at similar types of strategies in the longer term trading market to give investors comfort over the longer term that they're not going to have to wait and monetize their assets on a day ahead or an intraday basis.
Andy, actually, can you tell us a bit more on the reserve trials you've led that Aaron just mentioned?
Yeah, sure. Thanks, Aaron. So quite briefly, we realized during the COVID pandemic, when demand was suppressed, that suddenly all the volatility was gone out of the balancing mechanism because National Grid had to procure reserve from traditional sources. So they had to procure it from CCGTs mostly. But if there wasn't room to bring those CCGTs on, they had to turn off the wind turbines or create room via interconnectors. And we just thought that's a very, very inefficient way of providing reserve. It's kind of similar, and if you'll bear with me for the analogy, imagine you're going to a party or you're going to work, remember that? And you have to get home. What reserve is guaranteeing that you definitely do get home. So you book a cab back to pick you up 4 hours ahead of time. Definitely going to be there, and you pay for that up front. That cab drives to that point, gets in position, leaves the engine running, and then you may or may not take it, but you'll only take the cab if public transport isn't running. So most of the time, you don't need to take it. But in that moment that you do need it, it's there, great, and it's not that much more expensive than it would have been anyway. That's fine, but that's a very expensive way to create reserve. It leaves the engine running. It's a lot of, you're paying for the car turning up, even if you don't need it. You're paying to keep the engine running, even though you might not need it. And yes, the cost to actually take you home is small, but that's not really what you need. What you actually need is something closer to an Uber. If you're in trouble, you can order it in near real time, it appears, and then you get taken home. So you only pay for what you need when you need it. And I think that's sort of an analogy that kind of resonates in my mind. The only catch with Uber is it's usually more expensive to do that in the moment. It's usually 2 or 3 times the price to get you from where you are to where you're going. What we've just proven with National Grid and several others was that actually this trip, this on-demand trip to take you back if you need it, is cheaper than the alternative as well. There's savings there. So not only are you not wasting a load of emissions, not only are you not procuring stuff too far in advance, it's cheaper, it's flexible, and it's cleaner. And the good news for investors is the reserve market is probably around 2 to 5 gigawatts. National Grid said recently that the amount of reserve they need to hold is 10% of the wind plus another gigawatt or 2 as your base reserve holding. So it's a much bigger, deeper market for batteries and flexibility to operate in. And it could, in theory, be stacked with frequency control and dynamic containment, which is where the real fun starts.
Okay, thanks, Andy, for the good analogy. So the cab is the CCGTs and the Uber is the battery and
The electric one, yeah.
electric Ubers. Great. Maybe Kat, what do you think about this on trading and on this capability of having the batteries being available at any time? Is this something that are you more a believer into ancillary services or future revenues on trading yourself? We understood Aaron as more focused as his company on a trading house. Andy's done a lot of work on DC. What's your take?
Well, I'm not sure about Andy's analogy, but in terms of where Aaron and Andy sit, I hopefully sit right in between the two of them. So, you know, Limejump have always been, you know, we have a huge portfolio now. We're over like 1.2 gigawatts of assets. We have over 350 megawatts of flexibility. You know, we've got the experience of the last 5 years. You know, I think with 38,000, somebody told me hours of, you know, optimizing flexible assets. You know, we have a huge amount of experience in both the automation of the technology side, you know, first in the market. We've been working with Mark for a long time in terms of, you know, into FFR in 2016. You know, we've made a lot of mistakes along the way, but I think we've learned from them. I think one of the things that Limejump brings is that experience and the fact that, you know, it's about scaling now. It's all very well managing 3 or 4 battery assets, but it's about looking at your portfolio as a whole. How can you manage you know, a group of different portfolios, all those different types of assets, both your batteries, your gas, all the different fuels you have? How do you pull all that together and, you know, monetize those assets as much as you possibly can for the customer, as well as give them good customer service? It's not just about, you know, chucking all the cash, it's reporting back on those assets, showing how you're running them, showing how you're managing them. That's a really important part of what we do. And I think, you know, people know we do that piece very well. You know, it really is a combination of those two things. It's the technical automation. It's, you know, having a really experienced wholesale trading desk that have got a vast amount of experience in this space. You know, we also, I think one of the things we bring to the table is our engineering side of things. You know, we help people set up their assets. We help with all the metering side. We do some really complex setups for people. We're not just an aggregator. You know, we offer more to the table in this space. I think one of the things we've not talked about also is the collateral side of things. You know, we are now a 100% owned subsidiary of Shell. You know, having the collateral to post into some of these auctions now. You know, we have to post our own collateral onto the uncoupled markets. You know, they had markets were uncoupled at the beginning of this year on EPEX and N2EX. You can't. Yeah, there's a big chunk of cash that has to go with that. So there's all these different facets I think we bring into the mix for people that are wanting to build more batteries in the UK. You know, we need lots of different providers into this to push each other forward. We need National Grid, you know, continuously pushing these options forwards. But I think it's not just one or the other. It's a very complex mix of all these different things that come together. And I think, you know, certainly from a Limejump perspective, the breadth of experience we have is where, you know, hopefully investors will want to, you know, place their stock with us and really to take them forward to help them monetize and also look after those assets. You know, as Andrew mentioned before, it's not about overcycling those battery assets. It's about looking after them and making sure they can get them running in the long run.
Yeah, and that's
I just want to reiterate Kat's point there about collateral. It's such an important point that no one talks about in the space really. And you have so many startups in the space who say, okay, we're going to use this algorithm to do that, and we're going to use this to do that, and what have you, and we'll do all this sort of thing. The way the market evolves is we don't feel they're going to be able to scale their portfolio effectively without having their customers pay for the collateral. Kat's completely right, and we're the same at Vest. We can sort that out. We're a trading business. Collateral is a very big part of trading, right? So your trader should sort that out for you. You shouldn't have to pay that as a client, and it can be hundreds of thousands. If volatility increases, it could be millions of pounds, depending on the size of your portfolio. So I think, yeah, that's a great point that is very often overlooked. That we feel at Vest as well, a lot of the traders in the space aren't going to be able to scale their portfolio effectively without having their clients have to pledge hundreds of thousands, if not millions of pounds to the exchanges on their behalf.
Yeah, can I add to that? I don't know that automation and collateral are mutually exclusive things. I think, you know, we've been trading, providing collateral as part of the trading services side of the business. But you're right, it can work together. So if you have effective automation, you can actually have automated collateral management as well, which helps keep costs down for clients so that you don't necessarily have that picked up and having to manage that. So I think that works really well. And in terms of you know, the blend between automation and trading, I think it is not necessarily an either or, it's a how do you work together. And there's it's not just automated or not, there's actually quite a few different stages in between. And automation is definitely well suited to be close to real time, multiple time horizons, multi-market decision making. That's where it's very well suited. And there's an interesting analogy in the chess world. So, you know, a few years ago, you know, you had the AI beta grandmaster. That's all very exciting. Everyone's wondering about the dawn of AI, etc. But actually, in more recent times, they have seen that there's the blend of the two actually does better than AI alone or grandmasters alone. And the really interesting thing is that the role of the trader slightly changes, evolves, and becomes elevated. So actually, the experienced grandmasters can be beaten by new and innovative players that know how to work with AI, and they actually outrank the traditional ones or the AI alone. And that's really where we see ourselves as, to Mark's earlier point about collaboration. It's not just collaboration between parties, it's collaboration and learning those new skills for traders to how to get the best out of AI. It's an additional tool, and it should lead to increased revenues and lower costs.
So we're creating super traders with AIs that have new capabilities.
Yeah,
I
I
think
don't see
Andy's just, sorry, go on,
Oh, go on.
Andy.
No, you go,
I was
Kat.
just going to say, Andy's just perfectly sold what Limejump do. So I think my job here is finished in terms of having traders using the AI. So that's, thank you.
Let's take this out of aggregators, and maybe Mark's your point of view would be good on this. Andy said the market for reserve is probably 2 to 5 gigawatts in the next years, which is larger than what we thought probably 4 or 5 years ago on frequency response services. But you expect to build 1 gigawatt of storage. How is this going to pan out in terms of cannibalization, in terms of revenues? Do you think there's enough space for all of this storage to be installed? Oh, you're muted still, Mark. Here you go.
In a word, yes.
Yes.
Absolutely, there will be. Come on, guys. We've got 40 gigawatts of wind that even this Tory government is prepared to commit to build. On top of the 20 we have already, we have 12 gigawatts of solar, and God knows how much of that's going to be built. Certainly the wind alone will drive a very large fraction of that, the need for storage. Because storage is an essential order. It isn't an essential dish. It's not a side order. We're talking now about whether DC will be saturated. Who cares? It'll be something else in a year's time. And DC, yes, as Kat says, this summer they're going to make damn sure that it's not going to fail, but they're going to be procuring the hell out of it. And the speed with which we've been building batteries, we need to keep up, because actually, for all the talk about batteries, I love the way that some of the commentary that we've heard today in the show suggests that this, and has been doing for 3 years, that this market has arrived and it's mature and we're all. No, absolutely not. We mustn't mislead our audience, particularly those who haven't invested in this sector. We have some very smart people making real money now, much as those same very smart people said 2 or 3 years ago, and I was one of the less smart ones of them, that we could do this. But now they're beginning to do it. And matters like collateral will sort themselves out. Yes, we have to. We just signed today, actually, a significant deal with EDF, who have themselves been partners and what's the word, innovators in the delivery of the first serious floor in the market. Now, I'm not a great fan of floors, but we think that EDF have got a good team there, and of course, as a large player like Shell, they're able to provide some of that certainty for this route to market. But within months or within quarters or years, we are going to want to be able to contestably procure routes to market by different partners, by different times of day, by different applications, And indeed, given the wonders of electrical physics, procuring maybe reactive power from one system while providing frequency response from another. You know, it's these things are we're getting ahead of ourselves in terms of our ability. Now, I smile when Andy and Kat have a sort of love-in over the matter of automation and trading. Has anyone tried to trade a battery without automation? I mean, you know, I did find myself in a presentation to investors about 6 months ago saying, we better hire, or someone said to me, we better hire a battery trader. I thought, well, luckily we're not putting all these guys out of work because they didn't exist. And we only, at Eelpower, we only care about batteries. We're hardcore. We're interested in front of the meter batteries that are going to solve the nation's problem, which only Aaron, to his credit, has actually mentioned, which is to ensure that we make this energy transition work. And if we make this energy transition work, saturated markets at least not going to be a problem for the rest of many of our careers, even, they're definitely mine, because I think there's an enormous scope for different applications combined with the wonderful backdrop of the electricity market, which is a £14 billion market that we will be the center of. So just one final thing to leave you, the final thought on all of this. In the end, the grid is just like one big battery. And when you go to the wall and plug something in, what you kind of imagine in the back is a fully recharged battery all the time, because you don't kind of care. Well, we care because we're nerdy, but most people don't care. And interestingly, listening to the one of the two energy secretaries in Biden's administration, they said that's the way in the very simple political terms, we want to build the battery that is the new grid system in America, and God knows they need a grid system badly to replace the one they've got. But we're going to do it here first for obvious reasons, because we're that windy island, and I don't see capacity issues or saturation issues eating us up for very long, because if something becomes saturated like FFR, we move on. That's my thought.
Aaron,
Corey, I think everyone's worried about saturation, right? And I understand because of what happened in the FFR market. Everyone looks at BM reserve from storage, and I know it could be saturated if we get 2 to 5 gigawatts of battery. First of all, I'd say look at the installed capacity. We got just over a gigawatt, right? So we're a long way from saturation. If you assume 3 gigawatts of ancillary services with the new services rolled out, you assume 2 to 5 gigawatts of BM reserve from storage, you've got good revenue for at least 5 to 8 gigawatts, right? So to put it into context, that's where we are. And secondly, if you and I would say to investors, any investors sat there saying, okay, we did the analysis a year ago, 18 months ago, trading markets didn't provide the volatility that was required. Do the analysis again and look at the last year, and really it was a jump. And the story has always been, okay, we've had low volatility in markets. There will be volatility going forward. So build a battery, you've got the traded markets, which is gigawatts deep, tens of gigawatts deep, and you'll be able to monetize it there. The investor would look at the data and say, oh, historically it hasn't happened, so why would we build? It's a leap of faith. Look at the last year's data, it started. Look at the pricing we've seen in the wholesale market. You would have got a decent IRR, I think somewhere between 8 or 15%, depending on your battery size, how you built it, just through volatility in the wholesale and BM traded markets, right? So it's no longer that leap of faith. We're seeing it in the data, and we are coming out the bottom of this cycle. So I think volatility, in our view, is only going to increase. So you'd want to be early to the party, or you'll be sat in 2024, 2025. And this is my firm view, that you'll be sat there saying, okay, we'll build now. Volatility would have peaked, and you're actually moving into the next bottom of the cycle.
Okay, so we need 10 more. There's room for more than 10 gigawatts of storage and lots of.
There's room in the wholesale markets. If you put it into context, we've had nuclear, gas, coal. You can do tens of gigawatts. They're that liquid. Just the volatility hasn't been there for the investor.
Okay, so I have a question for Andrew based on that. What are the main challenges, Andrew, to build such a big storage? I mean, if we need to build 10 gigawatt of storage in the UK in the next 5 years, what are the biggest challenges as a manufacturer?
Currently, it is one word: availability. What we're seeing in the market at the moment, or certainly in the last few months, is lead times going out, particularly on the sell side. Stationary storage competes with obviously the technologies, and the main technology being the EV, of course. And what we've seen is huge swathes of capacity, manufacturing capacity, being hoovered up by the large automotive companies. And if you think about the battery manufacturers, static storage or stationary storage is around 5% of what they do. The EV market is far bigger, and therefore what we have seen is a lot of manufacturing capacity getting booked up, pushing out lead times, and obviously then having knock-on effects with pricing. And we've done, certainly at Sungrow, we've done a lot of work to try to with our suppliers, to sell suppliers, to bring those lead times down against something that is more acceptable and palatable for our customers, to keep them to a minimum. But it's a challenge out there at the moment. And then in terms of what the future, is really about scalability. Systems becoming bigger and bigger and bigger, and we certainly our systems are modular. They upscale well, but of course, as systems become bigger and bigger, they just become more complex. And we urge that when you choose a manufacturer, sticks to the basics. Make sure that it's a reputable manufacturer that's got good conversion efficiency, that's got good cell technology, and you'll be on the right track. Recently, one of our projects, we combined two chemistries on a particular large project. I think it's probably the only project in the UK that has a mix of chemistries in it. But again, it adds another layer of complexity. It's something that we're very much capable of doing at Sungrow.
Okay, thanks, Andrew. So we'll need to find more capability to build these gigawatt hours we need for the UK market. There's a question from the audience which I think is interesting, and probably that's for Andy, Aaron, and Kath. Interested, I'm quoting it, interested in views on scale and consolidation amongst aggregators. How important is scale to an individual aggregator, and what size of the market for aggregator in future, and what sort of services will they offer? Who wants to start taking this?
Yeah, I'll start. It's a really good question. There's a very high possibility that you could end up with the big 6 aggregators. I think at the moment, every man and his dog is trying to get into the market. It's literally anyone can run it from, their garage if they want to. But it's, I think the 3 of us have covered it off really well already in terms of, your tech has to be cutting edge. It really needs to be able to manage these sub-millisecond type reactions that we need to manage. The huge amounts of data. Like we're capturing 9 billion points of data every single month at the moment. It's how you actually, it's not just about capturing that, it's about using that to actually make informative decisions, both on the trading perspective and also managing the asset perspectives. In terms of, the services they offer, again, I know it's a bit of a repeat, but it is a combination of the things that I think we're all trying to do already in different ways. It's automating the right things, so you can really focus on the value add activities in the trading space, so you can make those combined decisions between trading and managing those assets. I think the collateral piece, we've already mentioned, but it does come down to that. They will have to be well backed, these companies, to support you in the investments that you want to make in your assets for the future. It's about providing good engineering services and innovative solutions in the engineering space as well. There's a lot to be brought to the assets if you put the right type of metering and management in place at the start. There are so many different ways we can look at this, but it's there is definitely a possibility it could go down that route.
Okay, so you can do it from your garage, but you need to be able to store all of these data, have a trader there, and
That's what, exactly. That's what's going to. There might be all these small people that can do really cool things and give you a really good price for your PPA right now, but who do you really want to put your assets with? Who do you really want? Like, you have to think about that quite seriously. I think in the medium term, you want someone that's going to be there for the long run.
Okay, and Aaron, maybe what's your?
Yeah, I think the opportunity for I don't really like the term aggregate anymore. I prefer trader just because they need to have access as a prerequisite to the traded markets. Aggregators historically didn't necessarily have that access, or some didn't have that access. So I think that's the key point. You need to ensure they've got a comprehensive market access framework. They can access the markets you need to be active in, and that sounds silly, but there are people out there offering certain services and not others. And I think, again, just to pull it all back together, and the point Kat mentioned earlier, it's about collateral and having someone who's creditworthy on the other side and saying, okay, are we happy with this person sitting on hundreds of thousands, if not millions of pounds of our money for 30 or 60 days, depending on what the payment period is? Is this counterparty able to pledge money to exchange to ensure that when the market gets really volatile and exchange margins go up, they're not going to have to stop trading our assets? Because if you look at historic returns for batteries and returns going forward, you can see in some scenarios that 15% of a battery's revenue over a whole year could be made through volatile market events. And you don't want to be with a trader who says, okay, we don't have the money to pledge to exchange, so we can't actually participate in this super high pricing.
Okay, it's true that from an industry perspective, we need to decide on wording, trader, aggregator, maybe we should say route to market or market access provider. Route to market? Yeah, we need to agree on something.
We call, if we're the buyer of a lot of these services, we call it route to market. I think there will be, has anyone noticed how many traders there are out there in the commodity markets more generally? I think there's a great opportunity here for the leading thinkers who are some who are around this table. But I think the prospect of a big six suggests we might have a domestic market dominated by, but this is inherently non-domestic. So I could easily see a bright bunch from Chicago or from Taipei saying, yeah, we can do this and we've got a balance sheet to do it. And the market is interesting enough. And God knows the market is interesting enough. So us as owners welcome that, because clearly these are alternative routes to market, alternative products that we can. All I would ask is that they make them competitive, because we want those routes to market to be as cheap as possible. Kat, Andy, Aaron, did you hear that? Cheap as possible. Write that down. Anyway.
Got it.
No commission. You work for free.
We have to still exist, though.
No, you can be paid fairly. I just say what's fairly.
Thank you.
Well,
I think pay for service, right? The service level.
Exactly. Yeah,
I think one of the interesting things about having a more automated piece is it does allow you to have less traders to get the same level of service out. So actually, it is a cheaper service,
absolutely.
Ultimately, and that's why we're going down that route, which is possibly slightly different in terms of we think we've got a very, very strong software offering. And one of the things, we talk a lot about flexibility. We say we don't know what the market's going to be, which is true. We don't know until a few days before dynamic containment exactly what it's going to be. Yet, if you've got a flexible software platform, you can be in there on day one, earning money on day one. And that kind of flexibility is something that I think is really, really important. That speed to market is only enabled through a very flexible, robust software platform that is controlling your flexibility. So a slightly different answer to the consolidation point, but we want to make that available to everybody so that we can ultimately lower the cost of route to market provision across flexibility, whoever's doing it.
Yeah, I'm being reminded that we are technically just above time, so we'll need to stop, unfortunately. But I hope everyone in the audience enjoyed as much as we did the discussion around automation, trading, how much revenues batteries can make, and how much space there is in the market, and what's the next steps, both for National Grid, batteries, and key takeaway for investors. So I'd like to thank everyone in the panel for this very interesting discussion. We'll all be available either later, or you can have our details probably to chat. Thank you very much. I hope you enjoy the rest of the conference, and have a good afternoon.
Thanks all.
Thanks, Corey. Bye, everyone.
Thank you.
Everybody.
Thanks, guys.
Thank
I just want to say thanks to all the panelists there for giving us their time. Thanks for all the attendees for taking part, and thank you to all of our sponsors who've made the event today possible. There is obviously more to go, so if you go back to the agenda arrow, you'll be able to see the next session, join that. And you can also contact all of the sponsors through the messaging app. So if you do have any other questions, or if you've got anything else you want to follow up with, please just use that and you'll be able to continue the conversation there. Thanks very much, everyone.
Thank you.
Thanks. Bye-bye.
Thanks, bye.
Thanks everyone. Bye-bye.